So, good afternoon to everyone. Please can we have a warm applause for Stephen Yu? Who is Stephen Yu? He's a multi-award winning co-founder and chief investment officer at Blue Whale Growth Fund. And also, exclusively here, he's doing a fireside chat with us. Blue Whale Capital are the platinum sponsor for this event today, and it wouldn't have happened without Stephen Yu and Blue Whale Capital and all the other sponsors. The reason I'm having a chat with Stephen, and the reason why it's interesting to speak to Stephen, is that Stephen always talks about outperformance, the investment philosophy, the stocks, and where future performance can be found. He's always looking ahead. Not, oh, that stock used to do quite well, therefore I'm going to piggyback onto that stock. Stephen's looking at the stocks that other people aren't looking at 3 years before they start looking at it. So I want to find out more about how he does that, what he's thinking, and all the rest of it. However, I want to start here now by talking about something that's happened this year. This year, if I'm correct in doing my research, and Stephen knows I like to do my research, is 25 years in business, Stephen, if I'm thereabouts. And this year, we've got a term for it. Stephen has had all the flowers been brought to him, right? What am I saying in that? FE Fund Info, which is the leading financial data company connecting the asset market management industry, it's a distribution network, has come and said, okay, Stephen, here you go. CIO of the Blue Whale Growth Fund, you are the winner of the FE Fund Info Alpha Manager Awards for 2025 for Global Developed Equities category. One on the way. Yeah, applaud. Absolutely, do that. As Chief Investment Officer of Blue Whale Growth Fund, we've inducted you in the FE Info Alpha Managers Hall of Fame. Wowza. Yeah, there's more to come. And just last week, Blue Whale Growth Fund received 5 crown ratings in the FE Fund Info's H1 25 crown rebalance. Now, I need to ask you about that, Stephen, because you had 2 crowns, not that you wear them at the same time, but then you jumped to 5. What were you doing in the outperformance level for them to go, listen, you were there from 2, jumped to 5, here's another award. What were you doing?
I think we have tried very hard. Thanks, Peter, by the way, for the introduction. The world is very challenging as we speak. I think the investment landscape today is a lot more challenging than 8 years ago. But what I would say, though, so I appreciate all the awards, but of course, all these awards are backward-looking in a way that obviously we have done well. That's why we got invited here to be a sponsor. But what is really important for me and my team is to be forward-looking, right? So if anyone who has been investors in the fund already or considering us being a product for your portfolio, that I'm forward-looking in a way that anything that has got us here, I think is great. But at the same time, the market's very competitive. So I would say that some of this award is a bit, comes with a lag after you have done very well, not that when you are about to start that journey.
Absolutely. No, I appreciate that candor as well and the level of humility. So I'm going to ask the question, that follow-up question was going to be, which of those awards and accolades you are most proud of on a personal basis and a team basis?
I think personally, I probably would consider the Hall of Fame awards to be quite telling, just because I think they look at a very long history of my investment career. And of course, when I look at the list of people who are on the list, which probably only about maybe up to 50 fund managers in the entire UK market out of a few thousand funds, I think we see some of the big names there. So I really welcome that acknowledgement or recognition. But of course, I think the challenge then is to keep myself on the list rather than in a few years' time that I might be probably no longer on the list. So I think that would be a quite good challenge.
Now, we talked about the team there, Stephen. So I want to talk about your team philosophy, research style, and you've got a unique, totally in-house and inclusive approach to your research with regards to your team. Please can you share with us that process, idea generation, time spent on average determining how stocks are added to the Blue Whale Growth Fund, please?
Yeah, so the way that I always try to explain this is that 5 of us on the investment team, we cover on average about 25 companies in the fund. So on average, on a professional basis, full-time, getting paid to do this job as well, like on average, we're covering 5 companies per individual, Which then, if you ask yourself, like I'm sure some of you would have a full-time job, and you're also investing your own money, and you have to ask yourself how many stocks or funds or whatever investment vehicle you have got in your portfolio, because ultimately, it's all about getting an edge or differentiated view. And in order to do that, you need to spend a lot of time, or a lot more time than my competitors who are equally professional investors doing it full time. And I think that is really important. And the way that we go about this is there are 5 of us on the team. And I think one of the things that I picked up over the course of 25 years of investment career is there's a lot of value, or increasingly a lot more value, to be able to build up your investment thesis bottom up, in-house, in a way that you basically go through all the primary sources of information that in the public domain, so anyone can get their hands on to. But at the same time, to piece together all the different moving parts, and ultimately, I think the value that you get from our investment decision is that we manage to make better decisions. And sometimes, I mean, it could be the right decision at a faster pace, and it ended up recognizing a mistake a lot sooner than later. I think there's some value to it. Or at the same time, you are able to spot an opportunity a bit sooner than later. So ultimately, it's very competitive. And I think when you have people who have the similar mindset, at the same time, I think doing something in-house is very important, so that you're not being reliant or dependent on external parties, right? Like I spoke about sell-side research before. I have no issue with the sell-side analysts being very high caliber individual, but they don't really work for us. They work for investment bank that speak to many clients. And I will assure you that even though that we've done quite well, we will be quite low on the list if we want to call them up to say, oh, what's your view on a certain company? So I think in today's era, things are happening very quickly. I mean, we build financial model, and I think it's very important that you have enough tools in-house that you can make the decision quite quickly when the time comes.
No, brilliant reply. I want to expand a little bit though, because you've neglected to do the bit of the answer that I wanted from you. So I'm going to just probe a bit more, if you don't mind me. The inclusive nature of how you do your research though led to one of your newest members coming up with one of the latest additions to your portfolio. Now, you're the chief investment officer, Stephen. So a lot of other peers are going, I'm the daddy here, I'm the boss. I'm making that decision. The new member came in the team and did their research, did their due diligence, came to the team and delivered a stock, which is now in your portfolio.
Yeah.
Tell me about that.
So the short answer is, obviously, I mean, we're speaking here and I've won these awards, but obviously, if I were just working on my own, let's say over the last 8 years, I probably wouldn't be here today. So in order to be the smartest person in the room, ended up being the face of it, is I think you need to welcome a lot of individuals' perspective or intellects or intelligence that goes behind the scene. And the way that we have managed to do quite well, which I would consider that as a very big intangible asset at Blue Whale that's not visible, is a team effort. And the way that we've done it is just firstly because we've really focused on numbers, facts, and evidence, which means that for anyone in the team, including myself, if you come into the meeting to say, oh, I really believe in this company, I like the chief executive, I think the valuation is very undervalued and there's a lot of opportunities, people will challenge you, like, where's your facts, where's your evidence, where's your numbers? I mean, if the company have been missing earnings for the last couple of quarters, I mean, what are you seeing that no one else is seeing, right, in the market? So people would challenge you, challenge myself, I would equally challenge other people in the team. And just because everyone in the team share the similar kind of mindset in terms of what ultimate constitute to a good investment decision, which is to be very objective, not emotional. And because we welcome an open floor debate, which is very important, that everyone, including myself, get challenged. So hence, we ended up having very constructive conversation, right? So then when you say, oh, I'm really going to back this company, you need to showcase what are the evidence or facts or numbers to justify that, right? Like if no one is going to, I mean, if that's not real, then you're just making this up and you're going to make yourself quite silly in the room, right? People are not going to respect you just because you are the CIO of the firm. And so I think we have that sort of mentality that help us to do some of the things that I mentioned earlier, to exit a mistake sooner, to spot an opportunity quicker, and then to maintain the status quo if nothing have changed.
Okay. I'm going to ask the question then. Everyone wants to know now, Stephen. what was the stock? Which was the company that the newest member gave to you to say, we want to buy that, and you guys went and bought it?
Was that European defense or?
I think it was. So.
Okay, so it was Leonardo. It was Leonardo. Leonardo just over a year ago, and obviously the position has got a lot bigger before the beginning of this year. And I shared about this earlier, if you were in my presentation, that it's not a typical area that we look at. I mean, we have never looked at European defense before. I mean, I look back in my investment career over the last the 15, 20 years before Blue Whale that I used to be a UK fund manager. So I have covered BAE Systems. There's a few other names like
Rolls-Royce.
Rolls-Royce.
Babcock.
And some others, right? So I did that for some years. That was probably in 2010 to 2013 or 2007 to 2013, which was a good time. But I think since then, the landscape is actually quite challenging. It's not very interesting. And of course, I mean, going back to the whole philosophy about maximizing our performance with some of these explosive opportunities, like you need to keep your eye open to it. So I would say that what happened at the time was when this analyst who proposed the idea to say, we need to maybe do some work on this, I think a lot of us, including myself, would be saying, oh, actually, are you sure maybe that's not a natural hunting ground for us? We have never invested in it before. Is that something going to change? But of course, we keep an open mind. So what we end up doing is, okay, why don't you do some work on it and then present the case? And what this analyst did at the time was he literally did a industry study. So he's basically looking at the entire defense sector, right? You're looking at the European defense alongside the American defense and some of the Asian defense coming, not many in Asia, but mostly in Europe and America. And of course, the conclusion based on all the data points or the narrative at the time with the Ukraine, later on with Trump, then we worked out that European defense within the defense domain, so not American defense, would be the natural beneficiary, right? Because we're not talking about defense per se, we're talking about a transitioning of spending from American defense, which is they were trying to back up Europe and Asia at the time, in passing the ball back to the European politician, right? So then suddenly that you worked out, okay, there's only a handful of companies, and so we narrow it down, and then we got Leonardo into the fund, which have done very well for us.
Absolutely. So we're talking about the beneficiaries, which we're going to cover a bit later on. So thank you for that. Now, Stephen, active managers continually form differentiated views on a company's market value. How do you and your team increase the possibility of ensuring not only your timing is right, but also you've chosen the right company within that sector regarding the field that you're looking at for future revenue and outperformance?
I think to pick the best performing companies within a sector is obviously a task on its own. But what I would say, though, just to echo on some of these themes that we have probably explored this morning, was that if you ended up, let's say European defense would be a good example. I mean, Leonardo is not the best performing stock in that market. I mean, Rheinmetall was the best performing one, but still Leonardo is up about 80% this year, which has done very well.
Absolutely.
But of course, then you need to get comfortable in terms of the company that you owned, whether it fits your investment process, your philosophy, whether it helped me to sleep at night, whether we actually understand the investment thesis behind it. But the point that I want to make is, if you manage to pick the right sector, sometimes it doesn't matter which stock you own, even though like Rolls-Royce and BAE would have done very well. Right?
Risk reward, right?
Yeah. So hence, I think if you spend more time picking the right sector, and at the same time you manage to pick the best company within that, then you make more money than you're just picking like a basket of stocks within the sector. But I think the starting point is like you probably want to have more tailwind, which is the sector dynamics, than just picking a stock in an industry that is not doing very well. And I would probably just jump forward to maybe luxury, that we have some luxury exposure, not big, but the sector is very challenged, right? Being challenged by different spending headwind. So hence, like to pick the winner out of a sector that's being challenged is a lot more difficult to make money.
Absolutely, love that. Now, you've spoken quite openly and candidly about the issues regarding the passives, or the trackers, as some of us like to call them. We've seen significant growth over the past decade as investors and institutions have piled in and hugged average returns from the various different providers, continually buying outperformers and then selling underperformers based on basically a company's market value any given day or week or month index tracking. You've spoken about this before, so I'm going to ask the question. What are the hidden risks of passives and trackers that the industry rarely talks about?
So it's actually a very big conversation in this topic, and I recently have done a podcast on this. By the way, if you're interested, you should listen to it. And it's a deep dive into the strengths and weaknesses of a passive tracker. I think on a very high level that the passive indices are very, very competitive in terms of the algo, in terms of buying winners and selling losers on a day-to-day basis, so being rebalanced on a day-to-day basis, and is embracing meritocracy. So there's no belief in terms of how ETF operate, right? It's not, they are true believer in quality businesses, low quality, value, growth, doesn't matter what they do or momentum. They just keep buying winners and selling losers. And over time, it worked out quite well. So if you look at, for example, the S&P 500 index, of course, I think American companies as a collective over the last couple of decades have demonstrated that they are the true winners in most industry they operate in. But when you look at the composition of the index over the last 50 years in the S&P, they are all very different. Every 10 years, right? The biggest company today are not necessarily the same biggest company 20 years ago. But then you keep changing that. So it's about basically keeping an open mind. But you need to understand that dynamics in order to do better. But of course, the downfall of that is always backward looking, right? It's backward looking in a way that is using the historical successes of company to get to where they got to. So any money being deployed to passive would reflect the historical success. And I would have used this example on Apple before. So Apple is still a $3 trillion company. I mean, if you ask me, would it be a good time to invest into Apple today, given Apple is in the crossfire kind of narrative between China and the US? I would probably suggest not. And if you understand how Apple got to where they got to, with Tim Cook outsourcing everything to China before designing California made in China, and at the same time before the AI narrative come into play, I think the index in itself are not going to reflect that today. But if we are right, being active managers, not owning Apple, and it ends up to be a smaller company in time, then you get the outperformance. But it's about taking a forward-looking view, and the index is always backward-looking. But having said that, the index algorithm is probably the smartest algorithm in the world, which have outperformed majority of active managers for the last many years.
You've run seamlessly into my trap there, Stephen, unfortunately. Could the passive investing industry and the active investing management model eventually face a threat from an AI purely tech selection model going forward?
From an AI perspective?
Yeah, just the algos going bloop, bloop.
I think... So firstly, I think there are two things going on here from my take on this. I think the market, firstly, since I started my investment career, and some of you have done that maybe a lot earlier than myself, is the market has become increasingly efficient over the last 20 years, right? 20 years ago, if you have managed to speak to the company, face-to-face meeting, or managed to speak to a sell-side broker, you probably get a bit of an edge in terms of understanding, right? But since we have all these regulations coming in place, it's a lot more difficult for a company to tell you things that they haven't shared in the public domain. At the same time, I think the value of sell-side research has come down a lot over the years with a lot of information being flowed to come to us directly, quite quickly with your Bloomberg app and some other apps that you have on your phone real time. But I think, and at the same time, you have a lot of algo trading that's going on, like quantitative hedge funds and some of the multi-asset funds. So the market is very efficient. But I think what is interesting to me is the rise of passive, which at the moment account for about 50% of the US market, and that number is still growing, right? More money is going to come out from my industry, which people are trying to take a view, a forward-looking view. Mm-hmm. Most of my peers probably have not done a good job, hence money are coming out, to the product that have done very, very well based on historical kind of your rear mirror. And that, I would call that like dumb money in a way that it actually makes the market less efficient. just because any money that come into the market would be allocated according to the market cap. That's not a smart decision.
Right.
But I think when you then build onto the AI, which is new, on top of what we are talking about here, I think AI is going to make the market even more efficient. So for me to do my job, which I will share that we have a bit of an ad. Oh, actually, I have to share with you this story. So a few months ago, I got this contact who actually pinged me a message to say, I've got someone who is using some AI to do research on NVIDIA. Can you help me to take a look at this research report and come back to me to see what you agree with or disagree with, right? So some contact. And I opened this report. It's like 100-pager. I'm not going to read it to come back to say, okay, I agree with this point, I disagree with that point and all the stuff, right? I'm sure there's a lot of things that I will agree with and disagree with too. It's too much work for me. I mean, that's not my job, by the way. But what I would say, though, is for people who haven't got the resource that we have got in-house to go through a lot of primary sources of information, going through any report, transcript, conferences, and all that, you probably can use AI to do that, right? You can upload the annual reports, transcript, conferences, news flow, everything, and I asked the AI to summarize what has Jensen Huang said, what did Trump said about European defense, like without spending time. So you would be able, on paper, get to a very similar decision versus us. See, on paper, right? Okay, whether it actually works in practice, I don't know. But what it means that then we need to do more. Yep. So what I'm saying here is AI at the moment is a threat to my day-to-day job in terms of generating alpha. I would say it's not yet, but it's coming. But it's the same thing as with all the information is being disseminated on a real-time basis, then we need to do more. So what we need to do at some point, then we might need to embrace AI too. But of course, with AI, it's like you do lose a few layers of information, right? I give you one quick example. When a company reports, you can spend an hour listening to the conference call, which is an hour of your time. You can decide to read the transcript later, not to spend an hour. You probably take you like 15 minutes to read an hour conference call. Or you can ask AI to give you a summary of the transcript, which takes you 2 minutes. But of course, what I would suggest is information will be lost in that translation. Because like if you hear the chief executive not answering the question or waiting for a few moments, you probably can get that element. Okay, whether there's any value, that's a question mark, but then you do lose different layers. So then by the time you get to an AI summary of a conference call, how much are you going to bet on that, right? How much are you going to have conviction on that summary so that I'm going to make a decision because I've spent 2 minutes reading a summary, which everyone in this room can do the same. No. And then it's not differentiated anymore, isn't it? So then maybe you still need to do a lot more than that. So I think but I think for the early adopters of AI, I think it would give you an advantage, which most people would not have.
I love that reply. Thank you very much. And again, seamlessly into my next question. Please describe to me your vision of what a successful global active fund reflects.
So the way that I see it is we've been through this journey. I think some of my audience here would have been invested in the journey. So thank you for the support over the years. But the one thing that I really think that differentiates a successful global fund versus not so successful global fund is every one of us would go through a period of underperformance. So every one of us would do well for over a period of time, but every one of us, including Blue Well, that we have underperformed for a period of time. But I think what really become important is what happened when you underperform. Like what do you do when you underperform, or how long of that underperformance would be? So from our perspective, we started the journey back in 2017. We have underperformed literally for 6 months in the first half of 2022. So we lost money, we underperformed, did very well in the first 4 years of the journey, but we fix it. We change, we welcome new ideas, we exited some holdings, and then we managed to recover very strongly, and hence where we are today. So what I would say, though, is for any managers in the global domain, because we are not fixated on a geography, like we can invest in the US, we can invest in the UK, it doesn't really matter, right? So there's no excuses, I have underperformed the world stock market because I have been underweight the US, like why? Like, if you say to me UK market is going to be the place to be, I will be overweight in the UK, which that's not our view today. So then the question is, when you do badly over a period of time, is you have three choices. One is you do nothing, which most of the time we do nothing. We just disagree with the market. We probably got the timing wrong. Like you could be too early. You say, okay, I disagree with the market narrative. Or you can make changes. You can say, oh, actually the market's right. There's some new information that comes in. You need to start maybe reducing or exiting some of the exposure. And thirdly, you welcome new ideas, which is, I think, going back to the example that I shared earlier, that European defense only became interesting since 2022, 2023, over the last 20 years, right? So you welcome new ideas that the world is a zero-sum game. There are always going to be some winners and some losers. It's never the case that you have everyone is going to win, right? So when you put all these things together, if you can make that three decision quite well, then you recover. I think recovering or from a setback and then continue then perform well again, I think that's what makes us successful global managers over extended period of time. And I'm sure in time we would go through something similar to 2022 again. But then it is our belief that we should be able to do this. If we can't do this, then there's no place for another global funds that are trying to mimic the global stock market.
Brilliant reply. Thank you, Stephen. Let's start talking now about outperformance, Stephen, which is what you've done, hence the rewards and getting all the flowers. Yeah. A lot of analysts, fund managers and institutions were wrongly bearish and in fact negative coming into 2025 with regards to the AI CapEx cycle. Then of course, I think it was January, maybe February, DeepSeek arrived onto the market, Stephen. And I want to know, and I think the audience wants to know as well, what were the metrics that you and your team identified or had previously identified that enabled you and the Blue Whale Growth Fund to remain steadfast with your AI holdings, some of which you've exited more recently, regarding keeping that long-term position in NVIDIA at that time? Because it also came out with news, I think, in January, February, which caused the share price to go down again. And a lot of the American analysts are going, oh, it's all over. We knew it was a bubble. And then obviously the share price has gone back to being all-time highs.
Yeah, I think ultimately the way that we go about this is you go back to the fundamentals of the company. So in a way that obviously we invest into companies, about 25 of them globally. And what you are going to ask yourself constantly, which is what we ask ourselves every day, is any of these external headline factors going to impact the earnings trajectory of our company? That's the only thing that matters, right? If inflation, interest rate, a Ukraine crisis, discretionary spending being squeezed, which is our wallets, are going to impact the earnings trajectory of your company, then that's not a good place to be. But if the answer is probably either not material or it's not going to have any issue, then any of this volatility in the market is just noise. Yep. So I was speaking to someone earlier, just an hour before, and we were talking about DeepSeek back in mid of January. And for some reason, which is quite interesting, we didn't foresee DeepSeek coming. So we didn't have the foresight to see, it's going to come. So hence maybe we should have reduced our AI exposure. But what we did though, of course, as soon as the news come out, that we have done a lot of research. And on record that I got invited by John's colleague, Marion Somerset Webb, to do a podcast on a Monday, which is the day that the DeepSeek news was announced on Saturday, on Sunday. So basically everything is crashing. And then we wrote an article on Monday night and published on Tuesday to suggest why we deem DeepSeek as the most welcoming development in the AI world. So we managed to come to that conclusion, which is still very valid today after 6 months on. At that moment, of course, I think the short story, without going to the nitty-gritty, is DeepSeek was built on NVIDIA GPUs, right? DeepSeek wasn't another Huawei that managed to create a GPU to compete, right? I'm not saying like Huawei can't do it in time, but that was not DeepSeek. It's a completely different company. But of course, to get to that conclusion, I think you need to be quite on top of your companies So you need to know by the time it happened, then you need to ask the right question, right? This is what sometimes AI means, right? AI is a tool. If you ask the AI, you give them the prompts, really intelligent prompts, they give you some intelligent answer. So I think for investors like us, you need to ask the right question quite quickly. And I remember at the time that many years ago, we were covering some other company like Salesforce. And obviously, I think Investor Day was a big deal for them. So they basically published this 100-pager or 200-pager of presentation. So they would have this meeting probably in the market, in the US market, when it's still open, have an Investor Day, publish this real time. And then we would literally sitting around the desk to go through the entire documents. When I say go through, we go to the right pager of that document as quickly as we can, which is the only 1 or 2 numbers that we're after is like how much, what was the customer signing up or what sort of outlook or the revenue increases. Like you get to that page as quickly as you can. And then you then decide whether that is still going to validate your investment thesis. But I think as a starting point, you need to ask the right question. And how do you ask the right question? Then you need to understand the business. What is the most important thing to the entire ecosystem of NVIDIA or the CUDA?
No, fantastic reply. Now, you spoke about understanding the business. So in order to understand the business, it gives you an opportunity to understand what the potential value is. Yeah. So let's move on, Stephen, and just ask you this. And I would like to ask at this juncture about valuations. And this is quite an interesting one. We had a conversation which we can't share on the stage here. We might be able to share it a bit later on. London Stock Exchange Group's CEO, David Schwimmer, recently stated, I think the narrative of different multiples in New York and London is frankly inaccurate. He went on to say, there is no significant material difference between listing in London or New York. Please could I ask you your thoughts on this regarding valuations for UK, FTSE 100, FTSE 250 companies, given those of the valuations regarding US large caps? Because the example I'm going to give you here now is that we've got a very large grocery store retailer in the US called Walmart. It's on a PE of 44.
Yep.
Thoughts, please, Stephen, regarding the UK and US valuation. And I'll add this bit in here that David Schwimmer went on to say. He stated, there's an embedded narrative that is not accurate regarding valuations between the US and the UK. Yeah,
so firstly, I disagree with that statement. I mean, some of the US peers for LSEG Group is trading at a high multiple per se. Okay, whether it's apple to apple, then we need to go into the different parts of the business. But one thing that I have been suggesting to companies or people who have made kind of the opposite comments is some of the chief executive is quite interesting. They would say, oh, quarterly earnings cycle is a distraction, right? You would have heard this before. We love quarterly earnings from an investor perspective because quarterly earnings give me the evidence, facts, and numbers to validate whether my thesis would be correct in the next 3 months. Of course, we don't invest in the next 3 months, we invest in the next 3 years. But anything that I want to get as much as I can, at least on a more regular basis, so that I can continue to roll over my time horizon by 3 months, looking out for over 3 years. And when chief executives say, oh, actually quarterly earnings is going to be a distraction, I mean, I look at most of my companies, most of them will be in the US. They are very large companies. I mean, that doesn't stop them doing well, does it? I mean, you think about like Microsoft, Meta, Google, I mean, they are all doing quarterly earnings and the chief executives are all over the place. Then my question is like, they're probably not ready. I mean, maybe you're not ready to be in the public domain because you can't do quarterly. But my point to that, though, to that is that it does provide a lot more liquidity. So if you think about in the US, okay, whether you welcome it or not, but that's not for me to say, is liquidity, there's a premium to that. So when you're going to welcome hedge funds who take a shorter term horizon, which is not us, who are going to participate in your company shares trading, it does provide liquidity, and liquidity has a price to it. So the more liquidity you have, the more valuation premium that you can get. So obviously, when you then put that into the context of what David has said is, okay, maybe on a like-for-like basis, the uplift in valuation is not as material. I mean, still a bit of upside, maybe 20%, not like 50. But maybe LSEG should be trading at a premium to some of these US counterpart.
It's a technology.
But you're trading, it's a data business, it's a technology company. I mean, I would imagine if Relics, which we don't own, have done extremely well for investors, in the US, it could be trading at 40 times, not 27 times.
Yeah. So the risk.
So then, how do you compare that, right? Like, it's one of the questions. But of course, I mean, we don't want to see more companies leaving.
We don't.
The London stock market.
No. I'm conscious of the time. I've already given a nod that we're running out of time, Stephen. But I've got this question I want to ask you because I think it's one of your overlooked stocks. Okay. Goldman Sachs AI leaders basket consists of 9 AI stocks: semiconductors, NVIDIA, TSMC, software and data center, Palantir, Oracle, Microsoft, Vertiv, GE, Vernova, Constellation, and Vintra. And that's been running that index since the 30th of November 2022, an average of 122% per year it's returned. The 2 top stocks in that portfolio since November of 2022 are NVIDIA, with a return of 979% as of Friday's date last week of the 8th of August. The second one is Vertiv, with a return of 910%. However, a lot of the focus regarding conversations with you and interviews with you are about NVIDIA. Can you share with us and this audience and talk about Vertiv very briefly for us, please, as to what it does, how it does it, and why it's in your top 10 portfolio? Yeah, so we have a position in Vertiv. Obviously, I think this is one of those things when you dig deep into a sector that you really like, you will end up finding more new ideas. And Vertiv is one of those names that came up after we already have quite decent exposure to AI. So what Vertiv does is they do the liquid cooling systems for AI data center. And as we know, AI data center, not just data center, is a lot more energy intensive. Right, so you need to have a lot of cooling systems. So what Vertiv does is an industrial company sitting alongside Eaton, Schneider, and some others. But Vertiv, as a company, has a lot more exposure to AI data center than the other some other peers. So it's actually quite interesting. But of course, what I've tried to expand on talking to some of you earlier is once you go outside of the true leader, let's say NVIDIA, which is at the heart of the AI conversation. If you believe in AI, NVIDIA would do well. If you don't believe in AI, nothing would do well, right? Including NVIDIA. It's once you go outside of that really what do you call it, like comfort zone, you go into the Vertiv, the liquid cooling. I think you need to consider other things as well. It's about the competitive landscape. Do they have the same moats as NVIDIA, which I would say that they have decent moats, but it's probably not as entrenched as NVIDIA. And so you are actually, it's about risk and reward, right? So then you take a smaller position, it's not as big as NVIDIA, but they would do very well as part of the entire ecosystem is concerned, because any spending that we come across today in terms of spending more money into AI, the $300 billion that the big tech have committed to spend this year, I would say half of that would have gone to NVIDIA and some of that would have gone to Broadcom, because it's all connected in a way. And of course, Vertiv, sorry, not Broadcom, Vertiv is a much smaller company. So hence, I think in terms of outperformance potential, it could do a lot more than NVIDIA, which is already a $4 trillion market cap company. What about 10 questions to ask you next? But I haven't got the time, so we'll have to carry this on later. I want to ask you one final question. And this is quite a very interesting one when I saw it and I thought, that's very interesting. So, Stephen, during Jensen Huang's, who is the CEO of NVIDIA, if no one really realizes that, he was in a live keynote speak at GTC Paris to commence Viva Tech 2025. Okay? And he spoke about Q2Q for quantum computing. Could NVIDIA lead the race for quantum classic computing on GPUs? And if so, could the revenues actually take another leap going forward and continue the growth for NVIDIA? That's going to be my final question. That's quite a difficult question. I don't actually have an answer to that, because I think the way to think about this is from our understanding, I would not consider our understanding to be really deep understanding at this point in time, is quantum computing was the thing before generative AI come along. Yes. Right? There was a period of time that people would imagine that quantum computing are able to do a lot of things that now generative AI are able to perform for us. Yep. So then the question is, what happened when the real quantum computing actually arrived, which probably would be at least 10 years away? Is that going to
be completely game-changing, or maybe some of the things is already be performed by the very powerful GPU today. I think that is still a question mark that we don't know the answer, but it's something to track, right? And then of course, then the point is, at some point, quantum computing, if NVIDIA are not able to transition themselves into this conversation, then it could become a disruption. Just like AI has been a disruption to most tech businesses, because they haven't got the AI parts, and then they now need to spend a lot of money investing into NVIDIA GPUs or Broadcom's GPUs. So quantum computing would be the next kind of leg, but I think at the moment might be too early to conclude.
I'll take that answer. Ladies and gentlemen, I'm sorry we've run out of time and we don't have time for some Q&A, but Stephen's stand is downstairs. You can speak to Stephen more directly. But ladies and gentlemen, and we no longer have a Lord with us, so we'll say ladies and gents, please have a round of applause for the multi-award-winning CEO, co-founder and Chief Investment Officer of Blue Whale Capital, Stephen Yu.
Thank you. Thank you.
Thank you, sir.
Thank you. Thank you, Peter. Great question.